So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday. It's the 6th of January, 2023. And what we want to do today is we want to have a look at the non-farm payrolls. We want to have a look at the release of the numbers, what was released, and especially what to make out of this. Why is the employment situation of high importance, especially right now? Before we start, and you watch the recording now on YouTube, not those who are participating live here at the event, but those of you participating or watching this right now, the recording on YouTube, please check out the subscribe to the YouTube channel. That was what I was talking about. I wanted to talk about. Subscribe to the YouTube channel from Admirals. So that you don't miss any of the webinars which we are producing for you here. Also, feel free to comment below the video if you have any questions. If you like the video, then please leave a thumb up here. And for those of you right now watching here live and in person, I want to now share my screen. Let me just click, and there we go. There we go. Can you see my screen? No? Once again. So there we go. And so let's trade the NFPs. Very important. In fact, it could be that we will make a trading setup a topic, but also that we somehow trade the event itself. That's why I recommend carefully reading this risk disclaimer here if we will make any trades, or if I will give any setups I personally a trade or something I find attractive. I could imagine to trade, even though we are not making the trade right here, but I probably make the trade a little later. Please be aware that you bear all responsibility for trading these setups and thoughts yourself. So that means what I present here to you are my thoughts. This is purely educational content. This is no advice in terms of trading or something like that, or investment. If you make any profit out of these thoughts, you're welcome, and I'm happy to share my thoughts here. If you lose any amount of money, then you're fully responsible for this. So please be aware that you understand the risks involved when trading FX CFD products here. And please don't misunderstand any of the presented content around the upcoming minutes here. It's purely educational content, no financial advice or something like that. The broker, I'd like to introduce Admirals to you. The broker behind this webinar series, Trading Spotlight, is Admirals, a broker which is in the financial industry for over 20 years right now, and is offering more than 8,000 financial instruments. You can trade them via CFDs, but also in physical form in an invest solution. Check out the website, admiralmarkets.com, for further information. Fully licensed broker, fully licensed by SISEC, by the FCA in the UK, by the ASIC in Australia, but also, for example, licensed by the financial authority in Jordan. Why that is, please check out the website for further information. Reach out to Admirals. I will share the contact details at the end of this presentation here, at the end of the webinar, so that you can reach out to Admirals, ask all your questions if there are any. What I can say when it comes to trading, over here in Germany, you usually refer to Admirals as the DAX expert, so highly competitive broker, especially when it comes to DAX trading, but also when it comes to FX trading. So long thing short, definitely worth a deeper look if you're interested in trading the markets. Fully regulated around the globe, one world, one broker in this context, but of our interest today will be, or are especially, the non-farm payrolls. And the question is what to make out of this data set. We will look into this data set. Well, probably we start that way around. We'll look into the data set. So I've prepared some tabs here, and I will start with the FX calendar. You can find on admiralmarkets.com, and there you have here the analytics tab, and there's the Forex calendar. If you click on Forex calendar, this site appears. Then you can filter which countries you wanna have a look at here. And in this case, if I apply the filter, you will now probably we take out euro. Oh, well, we keep it in. We keep it in. And there you can see that in addition to that, we will probably also want to filter by impact. So make it a high impact event, apply the filter, and then you will see that there's some events which took place today. This is, by the way, a European, respectively London time, so GMT in this case. So if you're witnessing this now from, let's say, Central Europe, I'm located in Berlin in Germany, for example, so I have to add 1 hour here. On top of that, you can also here choose your time zone you prefer. We'll keep it here with London time. And as you can see here, so numbers were released, non-farm payrolls. This was the release which we got to see today. Numbers came out 223,000. 200,000 was the forecast. Previously, we had 256,000. This is interesting because we will see. We will look at the chart in a few seconds what this means. And first of all, we want to start with the number itself, then why the employment situation is of interest, and what you can see here is numbers came in better than expected, but around the expectation. Because if you looked at the investment banks, for example, and their guesses for the non-farm payrolls, you could clearly see that the median here was around 218,000, and thus 223 is among what investment banks expected, was mainly priced in. This is probably one of the reasons why we can currently witness a bullish reaction. When you look at your chart, you will see that especially gold is pushing higher. And that might surprise you because you will see, and this is where this tab here comes into play, the Fed Watch tool. Because you might probably wonder, say, hey, wait a second, if numbers come in better than expected, this is usually probably foreshadowing to some extent that the Fed will probably not be as dovish as it is needed to justify a bullish push here in any kind, especially when it comes to gold. And thus it means that usually you want to see, or you would expect markets to drop due to yield expectations. So the Fed Watch tool, what does it? It's that you have a probability here for the next Fed event in this case, and what to expect here in terms of yields. And we started the day out. The thing is, unfortunately, I just updated the site. I had it open from the morning onwards, and I was looking at these numbers here, and what we could see around, let's say 5 hours ago, we had a column here of around 42%. What do these columns mean? Well, they mean, or they show you what's the likelihood of the Fed at the next meeting in this case here. So 1st of February, then is the next Fed meeting. What can we expect? Well, what is the market? It's not what can we expect, but what is the market expecting? In this case, the future market. What are market participants expecting in terms of the yield level here in this case, respectively the target rate. So current target rate we can see is 425 to 450, and market participants here right now, with a likelihood around 70%, expect another rate increase of 25 basis points, while in the morning, this column here was a little lower than that, so below 60%. So right now, as you can see, this column rose, which means that the likelihood that the Fed will only hike rates by another 25 basis points, that the likelihood increased, or that market participants here see a higher probability that this will happen. This is surprising because you say, well, the numbers were good, as you can see here, 223. So this is usually a sign that the Fed is likelier to hike more aggressive, right? Because obviously the US economy, in this case, the employment situation is not looking that bad, but in fact looks solid. So this is a surprising development. Let's probably fast forward a little, or jump into what can we expect here mid of the year, mid 23, around June. You can see you have several tabs here, and the columns then are extended into the future. And as you can see here, this is also dropping right now. So in the morning, the likelihood of the Fed hiking to 500 to 525, probably even higher than that, till June here, and that we see the Fed pivoting then around 500, but slightly above 500 basis points, mid of 2023, is coming back a little. So this is interesting because this just is not corresponding with each other. So usually, again, you expect a more restrictive policy path from the Fed because numbers were better than expected. So this is what we are currently seeing, and why, for example, gold, and jump over here, why, for example, gold is right now pushing back. Let's go to a 5-minute chart probably, why gold is pushing higher, pulling in a little, but we pushed above 1,850. And as we know, as you might know, gold is usually negatively correlated to yields, which means if yields are spiking higher, usually expect gold as a yield less investment to drop, and vice versa. And this is what we are currently witnessing. So before we now explain this in further detail, I'd like to go back to the presentation here and first of all, give you some insights behind the theory and what I was already talking about when it comes to the employment situation, economic situation, and so on and so forth. And we want to use a step-by-step guide, let's say, or go through a process to some extent, why or what happens next, and so on and so forth, to get a better understanding, even though it's only roughly a rough understanding, but it's still a solid enough understanding to then use the data and interpret it next time once we cover the non-farm payrolls, and you can trade this event yourself. So why are employment numbers of interest for us, especially as traders, and why do they cause volatility in the market? So first of all, there's a usual saying where when we say, okay, if there's confidence in the overall economy, respectively in politicians and politics, once this is solid and there's an optimistic outlook for the future, well, usually you expect companies then, respectively, companies to some extent. We talk about the manufacturing sector here. We could also talk about the non-manufacturing sector, services, and so on and so forth. But we want to focus here since it's I think it's easier to grasp to understand the manufacturing side here. We want to focus on this path part. So once there's confidence in the overall economy, I, as an employer / as an entrepreneur, I will say, well, you know what? I'm willing to take risks. I'm willing to invest money because I think there will be growth and we will see a positive overall and positive development in the overall economy. Which means if I'm running a factory in this case, and I'm confident that politicians are doing a good job and the economy is doing well, I usually get or increase my orders, respectively. I produce more given the fact that there's an increased demand for the product I'm producing. So there will be a natural increase in orders, which we'll get to see. That means in the next step then, as a result, what we get to see is an increasing industrial production. So which means that companies, and I as an entrepreneur in this case, that I will meet the higher demand through more investments, respectively produce more. What does more investment or producing more means? Well, it means that I have to hire more people producing the goods which are demanded in this case. So that means I need more people producing the goods. I hire more workers. So the employment situation brightens, let's say. And so we have a positive development there. Respectively, the unemployment rate in this case is dropping because I'm not the only factory in town, but I'm part of a bigger sector in this case, and there's more demand which we want to meet, which means, well, there's increasing factory orders, which means more orders needs to be fulfilled in this case, or more goods need to be produced, which means we need to hire more workers. So that being said, you have to pay well. So you can't just hire more people, but you also want to hire people of higher quality. Respectively, you want to have the best of the best people, or it doesn't really necessarily need to be the best of the best people, but the more demand there is, the more workers are needed. So if I'm not paying them well, I'm in competition with other factories, in this case, other people producing whatever good. Well, I have to compensate them accordingly. If I don't do that, well, they won't come to me, but they will join my competition in this case. So that being said, gives us an idea of why it is important to not just solely look at the unemployment rate or the numbers of the pure number of non-farm payrolls in this case, excluding the agrar sector, for example, but also have a look at the average hourly earnings, or average, not earnings, but wages in this case. So if you see higher demand and strong economic growth, and more people being hired, well, naturally, you have to pay them more money to stay with you to produce the goods, which means that the wages will naturally increase. So that being said, what does it mean? Well, if you have higher wages, where respectively you're paying more money, people have more money. So if they have more money, if they have a higher income, what does happen? Well, they consume more. It's not just that they will stay with you and produce more goods, but also there's an increasing consumption in this case, which means a higher propensity to consume. And this means, well, you naturally will see rising higher economic growth. And given the fact that they're paying more money and that there's overall more money chasing the goods which were produced, well, you also see an increase in terms of inflation, which then naturally results in especially if more money is chasing goods, that more goods are produced, which means you have to hire more workers, which is it's not a self-fulfilling prophecy, but it's a cycle which accelerates itself, which means increase in terms of inflation, which means central banks have to counter the rising inflation here and are motivated to raise interest rates then to avoid an overheating of the economy, and vice versa. So now the thing is, vice versa means we can completely negate this process here. So there's no confidence in the overall economy, or there's no confidence in politicians. Well, entrepreneurs, manufacturers in this case, are not producing more. Right now, the thing is that we are in a situation where especially inflation got out of control. I think we saw a peak out, and that's, by the way, one of the reasons why here in the Forex calendar from Admirals, I kept in the inflation rates here in the Eurozone. We dropped below, or we came in below 10% and below what was in fact forecasted here, which is very interesting because this peak out we could see it coming in this case, because already on Tuesday, we had inflation data from Germany, the biggest economy in the Eurozone, and this was already dropping quite significantly. So we can already see some kind of peak out happening here. But coming back to the overall inflation, so we saw a massive rise in inflation over the course of the last months, or till mid of 2022. Now you might wonder, why was that? Well, it's quite simple. We saw an interruption of the supply chains following COVID lockdowns and so on and so forth. And we countered the economic downturn, which resulted out of people staying at home and not working anymore, but shutting down the overall economy. We countered that. It wasn't us countering it, but politicians countered it by creating, or pumping liquidity into the overall system, creating money out of thin air, in fact, giving people, handing out stimulus checks and so on and so forth. They are handing out money to people. More people is then chasing fewer goods, which results in naturally increasing inflation. So there's no other way out of this. I mean, this is what we got to see. Surprisingly, many central bankers, especially from the Fed, but also here from the European Central Bank, Ms. Lagarde, for example, they were now looking at inflation numbers and saying, well, we couldn't see that coming. And you're just wondering, really? So you're getting paid nice amount of money for overseeing the monetary policy, and this is the, let's call it economics 101. So everyone going to the university in the first semester, this is what you learn. If there is supply, and then you have in this case lots of money chasing fewer goods, and there's a high demand for these goods, well, this will naturally increase the price of the goods. So this is simple. This is not very difficult to understand. And so right now it's the natural result out of the especially monetary stimulus, which we got to see following COVID, but also over the course of the last 10, 15 years following the great financial crisis, 2008. And so long thing short, so this is usually why employment numbers are of interest, because now the thing is that in the overall environment, especially with the recession forming at the horizon, you didn't really see an overheating of the economy, but it was more kind of a natural result out of the stimulus checks being handed out to people following the COVID pandemic. And in addition to that, not just following the pandemic itself, but also more money chasing fewer goods due to the fact that there was an interruption of these supply chains. So that being said, then now means, okay, well, we see an overheating, and people are now facing rising inflation, while companies, let's probably look at it from a quite straightforward perspective here. In Germany, for example, so the overall industry, you now see inflation everywhere. So it's not just that the milk in the supermarket is rising in prices, but it's also, and probably this is the reason for the rising prices in the supermarket. What you can also see is that, for example, heating or energy costs are getting out of control. In addition to this COVID pandemic interruption of the supply chains, there's also now the war in Ukraine, and the need, in case of Germany, for example, to get cheap energy from Russia to fund the overall industry. Due to the sanctions, well, this energy price development we got out of control, and that resulted in a dropping, in this case, gross margins, in this case, so less profit in case of the overall industry and companies. So they had to pay way more to produce goods, especially in Germany. And so how do you cover higher costs? What do you do? Well, first of all, you reduce what you're producing, which is adding, by the way, to the fact that we are not producing enough, and still lots of money chasing fewer goods. Okay, so this is driving inflation higher. But in addition to that, if you're not producing anymore, well, we don't need that many people working for you, which will naturally result in the employment rates rising. So you're firing people, you're laying them off because you say, well, I can't afford you anymore, because I don't have a job for you anymore, because we can't produce as much, because if we produce more, it's not only that I have to pay you, but in addition to that, I also have to pay for the higher energy prices, for example. And this is then resulting in the employment situation getting out of control, unemployment rates rising. And then the question arises, especially after now we saw a first counterattack of the central banks, like the Fed, for example, hiking rates, raising rates aggressively to counter inflation, that in addition to that, also money is getting more expensive. So it's not just that energy prices are getting out of control, but there's also more you have to pay, or it's more you have to pay for investments in this case. So you're not getting as easy a loan as you're used to get several years ago, which means now there's also less money which you try to take out of the system to get inflation down. And that means that the employment situation worsens, and usually people are unemployed or losing their jobs, which means if you're now seeing the economy decelerating, let's say, or cooling down, usually expect the employment situation to worsen, respectively unemployment rates to rise higher. If this is not the case, so, or if the acceleration here on the downside is not as aggressive as you expect it to be, well, the idea is now that you say, well, you know what, I don't really see a central bank to loosen their monetary policy that aggressive. Why should they? I mean, the situation in the employment world, let's say, is not getting out of control. So we are not as aggressive loosening our monetary policy approach as the market is probably expecting us. Why do I say that? I mean, how come that I say something like loosen monetary policy and following what the market expects? Coming back to here at the Fed Watch tool, what we have is you have these columns, and we are now in June. You see here 500 to 525 basis points. This is the biggest column. And if you add here also everything on the right, you see that the likelihood that this is the target rate mid of this year in June is above 50%. If we're now going a little further, you can see that right here, we already have a cut of 25 basis points priced in slightly above 50%, 475 to 500. 1 month later in July, at the end of July, going to December, you can see, well, the likelihood that we will have a target rate here from the Fed at 450, 475, and thus 500 basis points below the highest levels we expect in June, increases to over 70% in this case, or 70, no, 60%, 65 probably percent. That means that the futures market participants here are already saying, well, it could be that you continue to hike rates, but we really expect the economy to cool really significantly down, that you have to cut rates. And because we think it's not just the cool down of the overall economy, but in addition to that, we also expect you to lay off, or that the economy, the companies, the factories, and so on and so forth, have to lay off more people, which lose their jobs, which is naturally resulting then in pressure on politicians and thus also on central bankers, even though we understand that there's, or we know, not really for sure, but we expect there's an independence between those instances here. But there is certainly a connection that then the pressure will grow, that politicians will say, hey guys, especially in terms of the Fed, cut rates. So we have to, because we're killing our economy. And that being said, is already something which you can see being reflected here in the Fed Watch tool. So long thing short, you get to see a print above expectation, which was already kind of expected, let's say. So the median was around 217, 218 or something. 223, you can see here the forecast is 200,000. Median is a little above that. So the forecast is probably down to 200,000, because I think it was Nomura, a Japanese investment bank, which came in something like 100,000 or 130,000 or something like that. And this was dropping the average of the investment banks, which could be seen on Bloomberg. So the median, if you take out the 130, then you saw that there was a clearer bounce, a skew to above 200,000, 220,000 around. So it comes in as expected, let's say, from most of the market participants and investment banks in this case. So now, well, okay, you get the number as expected. It's not as worse, but still better than expected. And but it's not really increasing, but in fact, it's some kind decreasing the likelihood that the Fed will be more restrictive, but it's likelier that the Fed will be less restrictive and really follow probably the future market and start to cut rates in the second half of the year 2023. That being said, then brings us here to the charts and brings us, first of all, to gold and why gold is reacting bullish. Because you expect, if yields are expected to come down or are about to peak slightly in the future, and most of this being priced in already, especially from, I think, the second half, probably a little earlier already here in gold, being priced in, nearly fully priced in, that you now say, well, I now expect the market really to follow through on the upside. That's probably a good way to put it. And so that being said, is then resulting naturally in a bullish reaction. And in fact, right now, underlining my personal bullish BS, because in gold especially, what we've seen over the course of the last month around, so we are entering, and some of you probably recall, I was quite bullish for gold in the last webinars. I painted a quite bullish picture for gold. And we got to see that. So there's naturally a bullish seasonality into the yearly close and also into the start of the year, where gold usually performs well. And that corresponded here with gold pushing back above this blue line, which is the 200 SMA. So it's the simple moving average of the last 200 trading days. And we traded above that and we held it. And we continued to trade higher over the course of the last weeks. And so if we go down here and zoom a little out, you can see that there's a breakout area around 1,830 around. So this blue line here. And in the morning, a client of mine asked me, "Hey Jens, what did you think? If NFPs come in as expected, probably a little better than expected, what do you expect for gold? Because gold earlier this week already pushed above 1,850. Are we about to see a pull in and probably a deeper corrective move, probably even below 1,800?" And I told him I'd be really careful with that. And I said, well, I think the line in the sand for today is 1,830. So this is the region above which we broke. And if we can hold this level, if we can close, especially the week above 1,830, and let's see how NFPs come in. And they came in as expected, but slightly above expectation. So it's not the worst environment under which you see the US dollar especially perform positive and gold negatively. If gold performs negatively in an environment, positively in an environment in which you usually expect gold to perform negatively, personally, I'd say, well, this is a sign of relative strength. I wouldn't really overemphasize this, but this is clear bullish reaction on a better than expected, slightly better than expected NFP print. And we are holding above this breakout level around 1,830. And thus, I paint a quite bullish picture for the days to come if we can now close the week above 1,830. So if we make it and hold above 830 into the weekly close, I could imagine that we've probably seen slight pull-in, but not really going significantly below 1,840 USD. And then I could imagine this to be the bullish driver or bullish initiator of a push up to first 1,800, let's say 75. So the region here of the June highs around. And if it breaks above that level, I could also imagine quite quickly gold, not just to reclaim 1,900, but also probably push even as high as 2,000 USD per ounce. So something leaves me quite positive when it comes to gold. This is also something I told the client. I told him, well, to be honest, I don't know why, but I have a positive feeling for gold. So there were several headlines in the recent past, and it was about central banks are building their physical exposure. We need to be careful here because physical exposure, and we are looking here at the paper prices, and thus this needs to be looked at probably a little independently from each other. Usually you should, or especially if you go to, let's say, a bank and buying bullion, so you want you buy a bar of gold, for example, the price in which we refer to is the price you can see in the futures market, certainly. But still, I have to say that I think if you have physical gold, it has more value than it has when it comes to paper gold in this case. But if we look at it from a purely speculative perspective here, not going into too much depth around this topic here, I have a feeling that there's something brewing whatever it might be. And the relative strength here of gold somehow leaves me come to the conclusion that gold is probably about to break higher, and not just breaking higher above this line here. There's the red line around 1,875 USD, the June highs, but I really talk about breaking significantly higher and then trading back above, significantly above 2,000 USD, rather sooner or later, probably even in the first half of the year. Probably I'm completely wrong, but all signs point into this direction, and also my gut feeling is telling me something that we are probably about to break higher. Whatever the bullish driver might be, the fundamental catalyst might be, then we will definitely find it once we got to see it. But overall, the price action also today from a pure short-term perspective, given the NFP print, is solid. It's quite good, and as long as we trade above this breakout region around 1,830, I really could imagine trading gold from the long side and expect higher prices from here. So that's it around gold. But you probably also wonder, okay, well, what do you think about the NASDAQ? What do you think about equities in general? So it's not just the NASDAQ, but probably also the S&P. I want to be honest. Let's have a look here at the NASDAQ, because the S&P is trading stronger than the NASDAQ. As you can see here, we're trading around the 2022 yearly lows, so about to probably breaking lower, while the S&P here is also trading in a region where I say, well, if we break below, let's say 3,770, 780 on the downside, this could also be the driver for a push as low and as down as the 2022 lows. But I think a real clean bearish breakout is likelier in the NASDAQ here. And this is what surprises me, to be honest, because, well, we just painted a picture, especially in terms of yields, which is usually positive for the growth sector and especially the tech sector. But you can clearly see there has been occasions where we pushed against these lows. That was especially true here in November with this bullish push higher after the inflation print, which saw a massive cool down, and when we came in below 8% back then, a massive bullish run. But as you can see here, this bullish run died off soon after, and here within the Fed, and after the last inflation print, next inflation print will be next week on Thursday, so short spike to higher highs, and we were rejected and then sold off, and now trading as low as the 2022 lows again. So having that in mind and looking at this here, this is a clear sign of relative weakness. And I have to admit, especially when looking at the current developments, let's look at Amazon, for example. So they were just talking about laying off 18,000 people. Let me just check this out. 1 second, please. Amazon layoff. Where do you have it? Here's the Wall Street Journal. There, you can see that was from yesterday. Amazon layoffs to hit over 18,000 workers, the most in recent tech wave. So this is, I'm not sure if this is significant or not, to be honest, because I think this is something like, if we look at Finwiz, I think they have over 1 million employees. I'm really sure about this. It's also covering certainly the drivers, so on and so forth. Yeah, 1.5 million. So I think not that significant when you look at the overall number of employees here, but still significant enough to see a spillover effect on other companies. You've seen probably that Microsoft, for example, they haven't talked about layoffs, but yesterday or the day before, UBS, the Swiss bank, cut the price target for Microsoft due to their decreasing outlook for their cloud service around Azure. This is especially true and important when it comes to Amazon in this case, because Amazon has a true revenue driver with AWS in this case. So when carefully watching the earnings reports, you will see that AWS is this is where the money is made. So they're losing with their core business. In fact, they're making lots of money when it comes to their cloud business. Why is it noteworthy? Well, have a look here at Finwiz. They have a so-called heat map. And if you click on this heat map, well, you can see that Microsoft, but also Apple, but also Google, for example, well, these are big chunks in the overall market, especially in the tech sector, but also when it comes to the overall market. Also, Apple is noteworthy because Apple, as you might have seen, the stock, let me just click over here and let's check out 1 second the daily chart, and then I will see there's Apple. You can see here. So you can see also, this is a quite bearish looking chart, very topish, very, very topish, and recently broke to new 52-week lows here. I'm sorry, not really. So there was, we broke at least below the 2022 lows. This is also due to the question, well, what about the smartphone business and what about the growth outlook? Is it still given in a recessive market environment? So long thing short, the overall situation in the tech sector is not very prosperous, to be honest. And with rising yields, or yields which will stay at an elevated level due to the expectation that inflation will stay at an elevated level, and the big tech companies also now losing their steam, and the company which held the market higher, that was especially true for Apple here, selling off that sharply and seeing that relative weakness. And this is also true for Amazon, for example. Well, I don't really see a reason not to be bearish on the NASDAQ and expect a break lower here, and probably also a drop back below 10,000 points rather sooner than later, and continue the move lower, while we are still trading significantly above the lows from COVID, no question about that. Still, it seems likely that there's further downside of another 1,000 points here. If we drop 10,000, let's say 700, 9,700, 9,500 seems likely. And right now, as you can see, if we look at the developments, especially when it comes to gold and the reaction to the non-farm payrolls, well, the thing is, we just painted a picture which is positive. And I said, well, gold is usually negatively correlated to strength in the US dollar, respectively rising yields. If we get to see strength in gold, and yields are not rising that aggressively, which is usually a sign of bearishness in the NASDAQ, and the NASDAQ is then not following through and bouncing against these lows, this is usually a sign of relative weakness. And we should be really, really careful and potentially expect a break lower due to there will be rather sooner or later small spike in yields higher. And then if we break, well, if we break lower, then we significantly break lower, and the drop below 10,000 seems likely. And looking at here, the fact that we're trading close to these levels, it could be that the trigger will be found in the next days to come. And if it's not next week, then look out for the start of the earnings season from the week after that. So earnings season kicks off next week with banking sector starting next week on Friday, I think. And then the week after and the week after that, we get to see the big tech names. So Netflixes and the Microsofts and the Amazons and the Apples and the Googles and so on and so forth. And if these companies disappoint, or their outlook disappoints, especially when it comes to Apple, I don't really see a reason to be positive for the NASDAQ, but in fact, expect the drop lower and the drop also the run below 10,000 points in this case. So that's it around gold. That's it around the NASDAQ. And finally, let's have a look at probably Bitcoin. Some of you probably have wondered what do you make out of this? Bitcoin is really showing nothing of action, right? So it's like it's very volatile. Like there's nothing happening right now for whatever reason, but we are still trading below 18,000 points, and this is something I consider to be a clear bearish sign. And if there's any kind of bearish driver, risk aversion, I could imagine a next leg down to happen in Bitcoin. So right now, there's better choices. There's better markets, especially when it comes to the NASDAQ and the expectation of a break lower than on the downside. So I prefer the NASDAQ over Bitcoin here, but still, you should keep an eye on that. And don't get bullish in this current environment. To be bullish again, I'd really like to see Bitcoin reclaim the 200 SMA and trade back above 20,000. And right now, I'm not really seeing any positive signs here in this in this area, let's say, or any positive catalysts right now, so that we should be really careful in terms of long engagements in Bitcoin in this case. And that's it from my side. So I hope you enjoyed the webinar. I promised at the start of the webinar to share. I'm sorry, we have it here. Click. Doesn't it work? No, doesn't work. 1 second, please. Let me do it that way then. There we have it. Okay. So I promised to share the contact details. If you have any questions around Admirals and their services and their products, feel free to reach out to Admirals. Ask all your questions. Again, if you take any trades based on what I just presented to you, be really careful because that was purely educational in this case, even though it's definitely worth giving the NASDAQ and a potential break lower a deeper look in this case. And from my end, I can also only say happy trading. Watch your stops and talk to you again next week. I really look forward to it, to the next event. And that's it from my end. So have a nice weekend. Enjoy yourself. Happy trading. Watch your stops. Talk to you soon. See you.